Welcome back to the Property Investing Roadmap podcast.
An investment in knowledge always pays the best dividends.
My advice is consider the long term, the medium and the now.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
If you're wanting to snap up those opportunities in a competitive market, you need to be on the ball and be ready.
The first part is start early.
What's your goal in investing?
In Season 2, we're shifting gears to accelerate your journey through 9 key steps to financial freedom. From research and strategy to creating a model property portfolio, this is your step-by-step roadmap to building an income from property for life. Welcome to Season 2 of the Property Investing Roadmap. This season, we're breaking down the complex world of property investing into our proven 9-step framework. This approach is developed on decades of experience and has successfully helped thousands of investors across Australia. Each step builds on the previous one, creating a complete roadmap from initial research through to building, managing and optimizing a successful property portfolio. Our first step is research, learning and goal setting, which forms the foundation for everything that follows. Before diving into any investment, it's crucial to build strong foundations through research and education. Now, many Australians think they understand property because they bought their own home, but successful property investing requires quite a different skill set. Today, we'll explore why research matters, how to identify reliable information from unreliable, and the importance of setting clear goals for your investment journey. To help me unpack this topic, I'm delighted to welcome Robin Ram back to the podcast. You'll know Robin from the first season. He's the Property Acquisitions Manager at Momentum Wealth. Robin, great to have you here.
Thanks for having me, Damien.
Now, Robin, research is so critical, and we're going to talk a lot about that today, about particularly how you and your team go about researching the property market. But before we dive in, what sparked your own interest in property research and education?
I realised early on that my knowledge and my ability to help people were intertwined. And an example of this was going out at maybe 18 years of age, going out to look at a development site, R20, R40 zoning, and not having a clue what the potential was of this property. So taking a step back and going, there's a lot I need to learn here before I can effectively help a client. So that really sparked my interest in, wow, I need to learn a lot more than I thought I knew just from that real estate course.
And I guess back in those days, you would have had to go down to the local council and get the information there. It wouldn't have been online, I imagine. So, and how did you go about on that particular development site? How did you go about researching and understanding so you could tell potential buyers what they could do with that property?
That's right. Understanding the R codes. I had a lot of discussions with local town planners, so that nothing beats picking up the phone call and having a chat with someone who's approving developments within that area. And then also understanding where my knowledge was limited, and then going to one of my colleagues who'd handled many of these before and saying, here you go, can you please help this client? But I'd like to be involved. I'd like to be part of all those discussions. And that really helped me. So taking a step back to allow someone else to take lead who knew better.
Now, Robin, we've all bought property and we've all made mistakes. And I want to talk about your first property that you ever purchased, whether that be your home or an investment property. Tell me about the research you did before that step, and then we're going to get into what you wish you knew now when you bought that property.
Perfect. That's a great example because I knew the local area and I bought in the area that I was selling in. And that's very similar to what most buyers are doing. 7 out of 10 property purchases are from the same postcode or an adjoining postcode. So I knew my marketplace that I was operating in, but was that the best investment or not? In hindsight, it's done well, but could I have done better elsewhere? With what I've learned throughout my journey, I've realised that that same investment, same amount of money could have set me up much better had I made the right decision earlier on.
Yeah, and that's a lot of property investors do that. They buy in the same suburb, which I think is doubling down on where you live, because not only have you got your home there, you've also got your investment property as well. So in hindsight, it's crazy, but I know a lot of people do that, and it's obviously better to be in the market than not in the market at all. What would you do differently now, going back, looking at that first property? You mentioned it was in the area you were selling and you knew, but what would you do differently now if you had to go back and buy that property again?
I would have taken a step back and had a look at the bigger picture. I would have pushed myself out of the comfort zone of what I'm familiar with and what I know, which is the streets that I'm driving up and down every day, and actually ask myself a couple key questions like, what will perform well? What will people want to purchase in the future? What will a tenant look like that wants to rent this type of property? And with those questions, I might have actually slowed down my decision and looked for a different style of investment, and most likely in a different area.
There's a quote, and I've put it in the book, but education is learning what you didn't even know you didn't know. And that's always the hard part, is I've heard it called the unknown unknowns. You don't know what you don't know. So some of us know, when you know something that you don't know, at least you can go and research it. But for a lot of people, they don't know what they don't know. I think that's, and we'll talk more about that today, about property investing and what we see in our world when we're talking to clients about investing in property. Robin, why is education such a critical first step for property investors, and what sort of education do you think investors should be doing?
So I have a passion for learning. It's what I've been interested in self-development since a teenager. And there's a quote that I often remind myself of and I think of all the time, a Maya Angelou quote, which is when you know better, you do better. So as I learn and progress through life and in any different area, my ability to be a better person in whatever I do is limited to what I know. So I've got that motivation, that desire to enhance myself, my knowledge, and therefore I can now provide a better service offering, be a better parent, be a better partner, be a better manager, be a better buyer's agent, whatever those areas happen to be.
And I think that's important, Robin. Look, I'm still learning about property. I've been doing it for 30 years and I'm still learning things all the time. So it's just fundamentally something that you're never going to know everything. So, and we'll talk about why people don't get into the market, what holds them back a bit later on. But it's just so crucial that as a starting point for investors, getting a basic level of education about, and obviously from books and hopefully from podcasts like this, investors will get some fundamental understanding before they rush out there into the market. So, but Robin, at Momentum Wealth, what's the most common misconceptions you see from first-time investors when they're thinking about investing in property?
We hear a lot that people are focused on yield. So the first discussions are always around what's going to get me the best return per week so I can have the lowest holding costs on the investment property that I'm purchasing, which isn't always aligned, especially for their first investment, by setting up a correct process to be able to leverage your first investment to effectively buy your second and third. So it's a bit of understanding around what is capital growth versus yield and how those two interplay together. I find that's quite often comes up for discussion. And then it's the preconceived notions which are often publicly run through the media around what are the headline figures, what is the suburbs that people are calling out that have done exceptionally well within a short amount of time. And these people are coming in to see us with the idea that I need to be in this suburb or this area because that's maybe what I've heard on the news or that's where my friend has bought and made a little bit of money. Yeah. So it's around what is the bigger picture, what else can I be looking at, and then take that 1 year growth and then look over 5, 10, 20, 30, and is that still the same type of area or has it just been underpriced for a little bit, jumps up in price and quickly corrects again outside of a growth market?
And I think that's absolutely critical because when you're investing in property, you're looking at next 10, 20, 30 years generally. And what was hot last week or last month or even last year doesn't mean it's going to be hot again, and we do see that. But fundamentally, you've got to be out looking at what's going to drive demand and supply over the next decade plus, because that is what will drive property values. And look, I get the concept of about yield, and that's really is important to people because they've got to be able to hold those investment properties. But when you're buying an investment property, your total return is what you need to focus on. And for a yield that's slightly less than perhaps another property, you might find the capital growth potential is far superior. So just always keep that in mind. You're looking for total return from a property, not just cash flow, particularly if you're younger and in that negative gearing phase. Now, of course, Robin, when you and I started in property, there was no such thing as the internet, or if it was there, it was very minimal information. And of course, you had to get information from real estate agents or what you read in the paper. There wasn't a lot of ways you could get a lot of advice and information. But of course, now on the internet, goodness me, if you Google property investing, I imagine there'd be hundreds of pages on it, different opinions. So how do you sort good advice from bad?
Excellent question. There's a lot of information out there, and quite recently I've even tried some AI and just said, look, based on the research and data we have, let's just see what actually works with using different AI sources, and can that come up with the right side of strategy? Can it come up with the right areas for us? And even AI, it's relying on information that's out there, which is information that's provided by people who have a vested interest in some type of outcome. So it's around when I'm looking at sort of the advice and information that people need to look at to make that informed decision is what is the motive of the person writing the article? What is the motive of the person that's speaking to you or selling you or helping you? If there's more motivation in it for them than there is for you, then that's a bit of a disconnect and that could cause some mistrust. So if someone can take a common sense approach to what they're looking at and read the information, absorb it, but then ask themselves, how does that apply to me? How does that apply to my situation? Could there be other alternatives out there? Those sort of questions can keep you digging and look for a bit more information that resonates with you. I think a lot of people inherently know some of the good fundamentals of what a property can do, but it's when trusted public people or trusted sources start giving other information that you doubt, and all of a sudden you buy something that you wouldn't live in yourself in an area you'd never consider in, and then you're frustrated that your quality of tenants isn't what you'd want it to be.
Yeah, I think the best thing to look at is follow the money. So if you're looking at an investment property or something to buy, and someone's got a vested interest in selling that to you, whether it be a developer, whether it be a sales agent, well, you got to take that advice with a grain of salt, because of course they're going to say that's a good investment, and we see that all the time. And as a sales agent or as a sales agent working for a developer, of course you need to promote that property. That's what you paid for. So I think following the money is a really important thing, and that will sort of at least give you some idea on their inherent biases. But what other warning signs are there that property information or advice might not be trustworthy besides who's paying them?
When you take who's paying the person, because the person who pays is the person whose best interest that particular person is looking out for. So when you remove that, it's also around what information is the person providing about the broader context. So what is the exit strategy for that particular property? What can be the ups? What can be the downs? What can be the risks? A lot of the misinformation that I do see out there is when people just perpetuate just the good without giving the client that balanced perspective. I think proper advice from anyone within the industry talking to an investor is around what are the pros and cons of everything that you're doing for them, and allowing them to make that decision that works in their best interest, going fully into the negatives that are there as well as the positives. Some of the webinars I've sat into recently, I've actually posed questions on there and said, look, what's your exit strategy for this style of investment? How has capital growth performed for 5 years and 10 years in this area based on what you've seen in the last 12 months, which has been exceptional for this region?
Yeah, and I guess that's the other thing. Look, no property is risk-free. No investment is guaranteed. So you've got to think about that and about what might happen if something goes wrong. You've got to plan ahead for that. But absolutely, it's not all straight line up. And we have times in the market where market performs really strongly, and there's times in the market where it goes sideways or even backwards. So understanding all that is critical. And I think, as you say, a lot of people don't put the downsides. They just tell everyone about the upsides of buying a property. But why is it important to approach an investment property differently from what you might be looking for when you're buying a home?
It's the fundamentals of investment versus an emotional decision, which is your family home. My family home ticks my boxes for school, area, park, lifestyle, everything that I want from where I want to live. However, I would not be buying in the same area for investment fundamentals. I know that for an investment to have the returns and the goals that I want it to have, I need to have a bigger picture and remove the emotional side off that table. If we turn the decision to buy an investment property into, let's say, a business decision, where there you engage your logical part of your brain, and when you're using your logical part of your brain, you're going to make a better decision than your emotional part.
Yeah, look, in the book we give an example of different rates of capital growth, and it's just so important. Look, your home is actually absolutely your home. It'd be nice if you get good capital growth. It does help you get into investment properties, and that's certainly important. But ultimately, a happy family and a happy life is the number one priority. So you might buy in an area that may not necessarily, as you say, be best for capital growth. Hopefully it's still decent, but you've got to be happy in life. But as you say, when you come to the investment property, you've got to be very clinical about it. And we give an example in the book, and it's different capital growth rates on a $500,000 property at different rates. So 3% capital growth rate on a $500,000 property is going to be worth $672,000 after 10 years. Now, if you did a bit more research on that property or on the property market and looking for an investment property, and you found one that grew at 6%, well, that $500,000 property would then be worth $895,000 after 10 years. But if you really hit the jackpot and you did some fantastic research and had some good advisors around you, and you got 8% per annum capital growth, well, that property is worth more than $1,080,000 or thereabouts after 10 years. So all of a sudden, you've got $580,000 equity. During that 10-year period, you could have leveraged against that to buy more investment properties. So it becomes a self-fulfilling cycle. Buy the right investment properties. And when you do that, you'll actually be able to get into more investment properties simply because of that capital growth. It's just so critical. And I guess that's it. We do see a lot of investors out there in the world buy investment properties in their own suburb, or they talk to their uncle Bill, who's bought one property 30 years ago, but he's the world's expert. what sort of professional advisors should they look at when they're looking to research and buy a property? And obviously we'll come after that to, well, how do we know a good one from a bad one? But what should they be thinking about when they're researching, and what sort of advisors should they be looking for?
Further to your point about purchasing a owner-occupier home, there are a lot more people that have come to see us in the last few years that are buying their first house or their family home knowing it's a stepping stone, and then wanting to apply investment fundamentals to their family home because they know they want to actually use the equity that they make in this particular property to then get the real house they want in 2 years, 5 years, 10 years time. So some people are blending the two together, which can work quite well. When people are starting out on their research for that investment process, there's a saying, and again, I love my sayings, which is Navy SEAL one, slow is smooth, smooth is fast. So we slow a lot of people down when they come to see us because they've decided they want to buy an investment property and they want to have something purchased in the next week, 2 weeks, 3 weeks, because they've got this fear of missing out. Whereas we really want to slow people down at the early stage and go, have you spoken to, first of all, your broker? What's out there? How are you structuring your loan? Have you got a plan on what you're looking to purchase? If so, what are your tolerances that you want to go for? Have you spoken to a financial advisor if this is going to be something through a super fund? Is this something that's going to affect your future? So finding different people and starting with what can you borrow? What are the loans? How do we package these loans? Then moving it to an accountant. How do I best structure this for my family and my position moving forward? And only after then we would really want to start engaging then. Yep, your finance is there. You've got some approvals. You know what you're going to do. You understand the tax implications. You understand the setup of the names that you're going to be putting on this contract. And that way we're not fixing things later on and we're not having to undo mistakes 6 weeks into the process, 6 months, or once the property's already settled.
So look, let's move on to goal setting. Now, when you're looking to invest in property, a lot of people really haven't thought of past that first property. They're thinking, well, I'll just buy an investment property. I'm sure that'll make me money, and away we go. But I really like that quote from Alice in Wonderland. It's not a quote. It was in the book and in the movie about. Alice says to the cat, which way should I go? And the cat says, where do you want to get to? And she says, I don't really care. And then the cat said, well, it doesn't matter which way you go then, does it? Or words to that effect. I'm not reading the book directly, but I think that's absolutely critical too about setting goals. So what do you suggest investors do when they're looking to invest, not just in their first property, even if they've already got one? What do you say, and what does the team talk about to them about their property investment goals?
It's creating an accountability partner. A lot of people have a desire to be in a certain financial position by a certain time. But what happens naturally in life is we get busy with work, we get busy with family, we get busy with commitments, and we can easily defer our decision or wait to the whims of a marketplace rather than what's right for my long-term decision. So we like to work with people around, this is your end goal. To reach that on conservative calculations, this is when maybe you should be buying your first property. If this does this bare minimum in the calculations we've done, you can now buy one in 2028 and now another one in 2035. Now, that's not subject to market conditions because we're looking at the big picture. We're looking at how these properties will set them up for that 30-year window. So when they retire, they have more options. They've got that sense, now I can do this, now I can do that.
And look, we all want to buy at the exact bottom of the market, and that's what everyone wants to do. But fundamentally, it's been shown over many, many years, it's time in the market is more important than timing the market. So that's where it comes down, as you say. People want to rush in and buy next week because the market might be hot, but taking that step back, writing down their investment goals is just so critical because it gives them also something to aim for. So it's not just about this first one. Most people want to buy at least a couple of investment properties. So tell me about how you help investors break down their big goals into manageable steps.
So we're there as that accountability partner. Now, that's something that we do for our clients, but that's something you can also use for your own trusted network, and you can also have family, friends, a coach, someone else to hold you accountable to these things. So it's introducing them to the right people if they don't know them. It's then relying on the information that comes through there. It's then the step-by-step breakdown that we do. You've now done this step, now we do this, now we do this. Now we're ready to introduce you to one of the buyer's agents who will now get this property purchased for you. After that, it's the next step in the process, which is now you need your property managed. How are you going to get the best return? How are we going to maintain and add value to that dwelling over the next 5, 10, 20 years as well? So if we talk holistically about the whole package, it becomes quite difficult for a client when we're there every step of the way and we're reminding them the next step in your journey is this, the next step is that. The whole process isn't overwhelming and it doesn't create that sort of shutdown in someone's mind going, it's all too hard, I'm just going to put it on hold.
Yeah, and look, that's what you've got to battle through. Any success in any, whether it's investment or career or business or whatever that is, it's pushing through those tough times and seeing the bigger picture, the longer term goal, and that's just so critical. And we've seen it many times out there. People buy an investment property, they're not thinking about the long term goal and as much, and they're worried about the here and now. And the tenant leaves, and they've got some repairs and maintenance. They go, too hard, I'm out of here. And that's some of the worst mistakes I've seen people make. They sell out, and then when they want to get back into the market's moved significantly, or they've lost a lot of money to capital gains tax and transaction costs. So it's staying true to that long-term goal. Not always easy. I know life gets in the way, but it's also breaking it down, isn't it, to manageable steps. So, okay, goal one is for an investor might be just get that first investment property, and not only that, it might even be smaller. Well, let's talk to the broker. Let's get a buyer's agent, whatever those little steps are, and then holding their hand. Ultimately, the investor's got to still make that decision themselves, but you're holding their hand, I guess, through that journey, aren't you?
That's right, yep. And then it's that overwhelm is removed, because this week's step is to have one meeting with this person. Next week's step is to provide this information for your broker. The week after that, it's potentially starting to do some research on styles of properties out there. The week after that, it might be the introduction to someone who can help you facilitate that purchase.
Yep. Now, tell me about investors' fears and doubts. So it's all very well to do plans. I'm going to get this big portfolio, but of course, an investment property is not cheap. It's no matter where you are in Australia, it's hundreds and hundreds of thousands of dollars. So what do you suggest to investors? What should they do, as well as working with obviously good professionals? What else can they do to help overcome those fears and doubts before investing in property?
If you're not using industry experts to guide your decision, it's all about that information. And then it's also deciding when to commence that. So I can probably give an example. Just recently I had a chat with someone who wants to buy their investment property. They know they need to. They've got 2 young kids. They've got the income. They've made some money on their asset that they're living in, which is their family home. But they're just going, well, we can afford a property, but we really don't know where to begin. What should we buy? What areas should we consider? What style of property should we purchase? So it's breaking that down so that people can then actually go, all right, well, I'm going to consider first, this is my budget. Within my budget, what can I now look for? What are the areas? What are the pros of this style of investment? What are the negatives that are there? And asking yourselves those questions along the way. Because if you just decide, I'm going to go buy an investment property today, you may not be making that best decision. You'll go to a couple of home opens, you'll meet a great salesperson that tells you the area is doing well and the property's already got a tenant in it, and before you know it, you've purchased something without actually realising that actually you could have performed much better had you have taken a step back and looked at 2 weeks worth of home opens, 6 weeks worth of home opens, spoke to industry professionals, gone to home opens in various different suburbs, assess the livability of those areas, assess the type of tenants in those areas, look at the streetscapes, the gardens, the infrastructure, and then make those decisions from there.
And I mentioned it in the book, but just having education, no matter whether you're a seasoned investor or a new investor into the market, the more you know, the more you feel confident in your decisions. I've seen that many times, that people who do exactly what you say. They take a bit more time, they go to lots of home opens, they look at investment properties, they read the right material, they talk to the right people. That education gives them confidence, doesn't it, to go not just in the first time, but also the second and third time.
Yeah, when you're looking at what you're deciding to do, when you have that fear of making a decision, but you zoom out and you look at the bigger picture, you have a sense of relief knowing no matter what you purchase, if you hold it long enough, it's going to give you a return. So one of Perth's worst performing suburbs has gone up about 280% in the last 30 years. One of the best performing suburbs has gone up over 1,000%. So it's really finding a blend and not just buying anything, but if you are buying something, knowing that what matters is the purchase, what matters is the holding of that property. And even if you happen to buy the biggest dud that's out there and you still hold on to it, you're still going to make money if you allow time for that. However, we really want people to make that informed decision and buy the asset that will produce that return. There's a huge difference for someone selling in 20 years' time if they've made a 500% return or a 280% return.
Yeah, absolutely. And that's just that annual compounding of capital growth, just so critical. Robin, can you give us any examples of potentially clients who've been down this journey and how they went and how they got into the market and started building significant wealth through property?
Yeah, we've got lots of examples because a lot of people seek out these sort of services for us, and we're getting more and more younger people start coming through. These younger people are on some good incomes, they're wanting to set themselves up, and they're looking and listening for advice. So we're able to help them facilitate a good first investment purchase, and we're able to then to work with them over 2, 3, 4, 5 years, gear them up. And a recent example is a client we just helped with about a year and a half ago. He's made substantial growth on investment purchase. So their next step was actually 2 years away to buy their second investment. However, because they're in constant communication with our finance team and with our buyers agencies team, we're able to leverage that relationship that we've got and the equity that's been made, and we've able to move that decision forward for them. So we're adjusting that plan that's there because of the equity that's been made. But that was made from the client by taking a step back, trusting us in the process, and then buying well for their needs.
So, Robin, how do you stay motivated? You mentioned there some of the great steps that clients are taking. Is there anything else you could say about how to keep investors and how people should keep themselves motivated through that property investing journey?
I encourage clients to reach out on a regular basis, especially when there's a bit of doubt that creeps in. When you've held something for a while and you've had, like you said earlier, that maintenance cost that's come up, let's say the market conditions change and articles start coming about the market falling, that's when people start questioning their decision. So it's picking up the phone and having a chat with someone who's in the industry, reminding them of the bigger picture, why they've done what they've done, where they're going to be in that future. It can sort of ease some of those fears that people are feeling, like, oh, should I have done that? What am I doing? This is now costing me this, this, and this. And it's just one quick discussion with a consultant, and then all of a sudden you're like, oh, yeah, I'm back on track. That's okay. This is all part of the process. I'm here for the long term, not the short term.
So, Robin, thanks for coming in today. Any final tips or advice on people doing research, educating themselves to get into the property market? Any final tips you could give?
The whole topic, of course, is research. And I find some people can get lost in research and they're using it as a reason to allow procrastination, saying, I don't have the right information. I've got to research more. I've got to go to more properties. And we follow people up 6 months, 12 months later after initial consult, and they're regretting not making that decision 12 months ago, where their borrowing ability has now changed with what's on offer in the marketplace. But they're also now going, geez, I overthought the whole process. I should have just trusted it, gone with it, and made that decision back then. So not getting lost in the volume of information that's out there and not using the information as an excuse to not make that decision and move forward.
Yeah. Final tip from me, research is so critical, but you don't want to get paralysis analysis. And that means a lot of people get paralyzed. There's so much information. You'll never know everything. So what you got to do is get the right advisors around you, know enough to know exactly what you're doing and that you're going down the right path with the advisors. But it gives you confidence, but you'll never know everything. And I think another thing is setting big goals, but break them down into smaller steps. So if you say, I want a property portfolio of 8 investment properties, well, I haven't got my first one yet. Gee, that sounds daunting. Oh, it's all too hard. The first thing you do is break it down into smaller steps. If you want to build a big property portfolio, you've got to start with the first one. So the first one, and even that has a lot of steps to it. So it might be go and talk to your mortgage broker, start researching the market, go and talk to buyers agents, get all the information you need and be comfortable, plan your cash flow so you can afford that property. And that's all those smaller steps. You tick them off one by one. It gives you confidence and fulfillment that you're getting through that process. So really important to break them down into all those big goals down into smaller steps, particularly the here and now, what you can do in the next 6 months. And the other thing is don't let the what ifs hold you back. I've seen a lot of people out there, they get excited about property, they set their goals, but they go, oh, what if interest rates go up? What happens if I lose my job? What happens if the tenant leaves? All those things, you know what? They could all happen. And there's a way to mitigate those things. So firstly, obviously, we want to make sure we've got a cash buffer. So if interest rates do go up, we can afford that, and or can we get fixed rates on a loan if we're particularly worried about it? The tenant could leave. Yes, that's correct. But hopefully you've planned again enough cash buffer so that you've got a sufficient cash should that situation happen. So you can't let the what ifs hold you back, because if anything can go wrong, and who knows what's going to happen in the world economy. I guarantee you no one knows in 12 months from whenever you're listening to this podcast what the economy is going to be doing. Nobody in this world, no one knows exactly what's going to be happening. Some people think they know what's happening, but there's so many moving parts to everything. You just simply can't plan it out and be certain. That's just part of the risk you've got to take. Write down the goals, and as we said, write them down, break them into smaller steps, and be specific about them, and actionable items so you can tick those things off as you go through them. Gives you a sense of confidence and that things are happening and progressing, and you'll move on to not only, I think, your first investment property, but hopefully, if you do all those things, start to build a large property portfolio. So thanks again, Robin, for coming in today. I look forward to having you on step 2 of the property investing roadmap, where we're going to talk about how we can create a plan and actually take action.
Thank you, Damian. I look forward to finding a few more quotes as well so we can amp up our quote game in the next one.
Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note that the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied on for investment or financial decisions. Always seek professional advice before deciding whether to invest.